Hello and welcome to our channel. Today we'll talk about initial coin offering. It is an event where a company sells a new cryptocurrency to raise money. Investors receive cryptocurrency in exchange for their financial contributions. In many ways, an ICO is the cryptocurrency version of an initial public offering in the stock market. Although with ICOs, you can make significant profits, the lack of regulation makes them extremely risky. In this video, you will learn all about ICOs, including how they work and some notable examples.
Did you know? A total of 21 million bitcoins could be produced, which would be mined gradually by making the mining process more complex. The last coin will be mined in 2040. ICO stands for Initial Coin Offering and refers to previously favored raising capital for early-stage cryptocurrency projects. In an ICO, a blockchain-based startup mints a certain amount of its digital tokens. It offers them to early investors, usually in exchange for other cryptocurrencies such as Bitcoin or Ether. As a type of digital crowdfunding, ICOs allow startups to raise funds without giving up their capital and create a community of motivated users who want the project to succeed so that their pre-sale tokens grow in value. While ICOs can offer an easy funding mechanism and an innovative approach for startups to raise money, buyers can also benefit from access to the service provided by the token and from the increase in the token's price if the platform succeeds.
ICO is another form of cryptocurrency that companies use to raise capital. Through ICO trading platforms, investors receive unique cryptocurrency tokens in exchange for their cash investments in the business. It is a means of crowdfunding through the creation and sale of a digital token to fund the development of a project. This unique token functions as a monetary unit that gives investors access to specific project features launched by the issuing company.
Tokens are unique because they help fund open-source software projects that would be difficult to fund with traditional structures. When a cryptocurrency startup company wants to raise money through an ICO, it usually puts its plans in a white paper to provide important information to investors. This information will include, but not be limited to, what the project is about, what the project's goal will be when completed, how much money is needed to take on the venture, how many virtual tokens the issuers will keep, what currency is accepted, how long the ICO campaign will last, and who is behind the white paper. The company running the ICO prepares a white paper before launching the currency. This is a critical component of an ICO, as many investors ask for a white paper to be prepared before deciding to invest.
With an ICO fundraising model, startups can raise capital by issuing tokens on a blockchain and then distributing tokens in exchange for a financial contribution. These tokens, which can be transmitted online and sold on cryptocurrency exchanges, can perform many different functions, from giving the holder access to a particular service to entitling them to receive dividends from the company. Depending on the process, tokens can be classified as service tokens or security tokens.
Service tokens, called user tokens or application coins, represent future access to a company's product or service. With service tokens, ICO startups can raise capital to fund their blockchain projects in exchange for future user access to the service. Communal tokens are not intended to be standard investments in a company's stock, and if properly structured, these feature exempt service tokens from federal securities laws. By creating service tokens, a startup can sell digital coupons for service under development, similar to how electronic stores take pre-orders for video games that may not be released for months. Unlike service tokens, if a token derives its value from an external traded asset or can increase in value based on the efforts of others, it may be classified as a security token and subject to federal securities regulations. Failure to comply with these rules can result in costly penalties and can derail the project. Consequently, businesses must comply with all of their regulatory obligations. Once a token is classified correctly, a wide range of applications are allowed, the most promising of which is the ability to issue tokens that represent company stock.
When a company decides to hold an ICO, it announces the date, rules, and purchase process in advance. On the day of the ICO, investors can buy the new cryptocurrency. Most ICOs require investors to pay using another cryptocurrency, with Bitcoin and Ethereum being two standard options. There are also ICOs that accept fiat money. The purchase process usually involves sending money to a specified cryptocurrency wallet address.
The number of tokens sold during an ICO and the token price can be fixed or variable. Here are examples of how these can work. Fixed number of tokens and price. The company sets both of these parameters in advance, for example, offering 1 million tokens at $1 per token. Fixed number of tokens and variable price. The company sells a fixed number of tokens and sets the price for them depending on the amount of funding received. The larger the budget, the higher the cost of the token. If it sells 1 million tokens and raises $2 million, each token will have a price of $2. The variable number of tokens and fixed price. The company sets a fixed price but does not limit the number of tokens it sells. For example, the company sells tokens at 50 cents each until the ICO is complete.
Anyone can launch an ICO. Because of the low barrier to entry, many new types of cryptocurrency are found. At the most basic level, launching your own ICO is a matter of creating a cryptocurrency token, setting a date and rules for selling tokens.
To successfully raise funds, the ICO process requires much more than that. The most important part is the cryptocurrency project that people are interested in supporting. You also need to determine how much of the cryptocurrency you're launching will fit into the project. And during the ICO process, you will need all of the following: a technical document describing your project, a roadmap with short-term and long-term goals, market research on other ICOs, website, social media presence, marketing campaign. With everything that goes into an ICO, you need a dedicated team to succeed. You can build a team yourself or work with an ICO company that specializes in these offerings.
Any token sold through an ICO is considered a high-risk investment. The market is still under-regulated, fraudulent ICOs are typical, and investors have no protection if an ICO fails or turns out to be fraudulent. A 2018 Satis report for Bloomberg stated that nearly 80% of ICOs at the time were considered fraudulent sales.
For anyone looking to participate in an ICO, it's essential to include the following in the due diligence process. Review the project team to see if they have a demonstrable track record of building a successful business. Ideally, team members should also list their social media accounts so they can be contacted. Examine the white paper and project roadmap to see how the intended product or service will work, including when certain features will be launched. Check to see if a third party has verified any computer code. This will be a good indication that the project is taking its security seriously. Look for typos on a website. This is usually the first red flag that a website was created quickly, without much thought, and may indicate this is a scam. Tokens, especially those that have been successfully sold, are usually listed on cryptocurrency exchanges. Once listed, new investors who missed out on offering tokens have the opportunity to purchase the coins. If the project promotes itself well, there may be significant demand for its tokens after the ICO.
It all started in 2013 when software engineer Willett wrote a white paper called the Second Bitcoin White Paper for Mastercoin token and raised $600,000. By 2014, 7 projects had raised a total of $30 million. The largest was Ethereum. 50 million Ethers were created and sold to the public, raising over $18 million.
2015 was a quieter year. 7 sales raised $9 million. the largest of which, Augur, raised just over $5 million. Activity began to pick up in 2016 when 43 ICOs, including Waves, Economy, Golem, and Leask, raised $256 million. This included the infamous token sales of Project DAO, an autonomous investment fund that aims to boost the Ethereum ecosystem by allowing investors to vote on projects for funding. Shortly after the deal brought in a record $150 million, the hackers siphoned off about $60 million worth of Ether, causing the project to crash and the Ethereum protocol to hard fall. The DAO debacle didn't stop the growing enthusiasm for the emerging digital asset space. In December, the first fund dedicated to token investment received significant support from old-school venture capitalists. ICOs hit a new peak in 2017, thanks in part to recent technological advances. 342 token issues raised nearly $5.4 billion and brought the concept to the forefront of blockchain innovation.
Thank you a lot for watching this video. Stay tuned for more videos.